Yeah, okay, that makes sense. So if we go back to, I guess, what we were talking about before, how you said that majority of sort of returns come at the start of the liquidity cycle. We've probably seen at least 2/3 of the returns currently. So would you say then the risk on is the play to go, or do you think there are sort of other cyclicals or other, I guess, assets that are going to perform better over the near term?
Well, I mean, we're still risk on. I mean, we've been risk on since October of 2022, and we're still risk on. I mean, you can trade around that. I mean, markets never move in straight lines, but I'm giving an investment strategy, not a trading strategy. And I think from an investment strategy, which lasts 5 to 6 years through the liquidity cycle, that's exactly what you get. What you're looking at periods of risk on or risk off that can last 3+ years. So we still think we're in a risk on environment, and everything that we look at supports that view. You've got the evidence is there in liquidity. The evidence is there in terms of the sectors of the stock market that are performing. Technology was the leader. That's pretty typical. You're starting to see the recovery in markets beginning to broaden out now. That's another feature you'd see. Around that time, you start to see evidence that the economy is bottoming out. That's what I suggest you're getting. You also see evidence that yield curves are steepening. You're seeing that. So everything we see seems pretty much in line. And what's more, as I alluded to earlier on, US dollar is beginning to weaken, which is normally something you see around this stage of the cycle. If you look at Bitcoin responds much more to the cycle in liquidity. It's much, much more sensitive. If you looked at the, if you like, the loadings or the sensitivity factors of gold and Bitcoin over the past 5 years, to take an example, gold has moved for every 10% rise in liquidity, gold has moved upwards or downwards by about 15%. If you look at Bitcoin, the average in the last 5 years has been about 40%. So there's a big, big difference. In other words, Bitcoin is about 3 times the effect that you would see on gold. It's very sensitive to movements in liquidity. And because liquidity also affects general risk assets like equities, therefore you see that correlation between Bitcoin and the equity market being borne out. Now, that's the experience we've had recently. Over the medium term, I would also suspect that you're likely to see Bitcoin similarly matching the trend in monetary inflation. Equities will do that as well, but the faster that monetary inflation trend, the more that equities will lag behind traditional monetary inflation hedges. So if you go back to the 1970s, for example, equities were initially a very good performer, but as inflation began to pick up, both consumer price inflation and the pace of monetary inflation, then you started to see equities lagging real assets and gold and commodities. And there's no reason to suspect that won't happen.